Why is everyone suddenly talking about holding at least 100 ounces of silver? What's changed in the market that's making this specific number so critical right now? I'm going to walk you through exactly what's happening behind the scenes, and by the end of this video, you'll understand why this isn't just another precious metals hype cycle. This is different, and the data proves it. Let me start with something that should concern every American watching this. The silver market is now in its sixth consecutive year of structural deficit. Think about what that means for a moment. 6 years in a row where global demand has exceeded supply. Not a temporary blip, not a seasonal fluctuation. 6 straight years of the world consuming more silver than miners can pull out of the ground. And here's what makes this absolutely critical. That deficit is accelerating, not slowing down. The Silver Institute just released their latest analysis, and the numbers are staggering. Industrial demand alone is consuming massive quantities of silver that simply cannot be replaced. We're talking about solar panels, electric vehicles, 5G infrastructure, medical devices, water purification systems. Every single one of these technologies requires silver, and there's no substitute that works as effectively. Silver has the highest electrical conductivity of any metal, the highest thermal conductivity, and it's the most reflective. You can't just swap it out for copper or aluminum and expect the same performance. But here's where it gets really interesting. While industrial demand is eating up supply, investment demand is surging simultaneously. And this is creating a perfect storm that most people aren't paying attention to yet. When you have industries that must have silver to function competing with investors who want silver for wealth preservation, and you layer that on top of a market that's already in deficit, you create a pressure cooker situation. Now, before we go deeper into this, I want to mention something quickly. If you're watching this and thinking about how to protect your wealth in this environment, I've put together a free guide in the description below. It covers the saving secrets that thousands of American retirees are using right now to protect their hard-earned wealth. It's completely free. Just check the description. Let's talk about what's actually happening at the COMEX, because this is where the rubber meets the road. COMEX silver inventories have been declining steadily, and they're now sitting at levels that should make anyone paying attention very nervous. We're looking at roughly 82 million ounces in registered inventory. Now, that might sound like a lot until you realize that global industrial demand alone consumes over 650 million ounces annually. The COMEX registered inventory represents less than 2 months of global industrial consumption. 2 months. Think about that for a second. If you ran a business and your entire industry only had 2 months of inventory for a critical component that takes years to mine and refine, would you sleep well at night? Of course not. And that's exactly the situation we're in right now with silver. But it gets even more interesting when you look at who's buying. Central banks have been on an absolute gold buying spree, and while they're not buying silver in the same way because it's not a monetary reserve asset, the smart money is watching what central banks do with gold and making the connection to silver. When central banks buy record amounts of gold, they're sending a signal about their confidence in fiat currencies. And silver, historically, has been gold's more volatile little brother. When gold moves, silver tends to move harder and faster. The gold-to-silver ratio is another piece of this puzzle that's absolutely fascinating right now. Historically, this ratio has averaged somewhere between 50 to 1 and 60 to 1. There have been periods where it's gone much higher, and periods where it's compressed significantly. Right now, we're in a period where silver is undervalued relative to gold by almost any historical measure. And when that ratio compresses, as it inevitably does, silver doesn't just catch up to gold, it rockets past it in percentage terms. Let me give you a historical example that perfectly illustrates this. Back in early 2008, silver was trading in the low teens per ounce. By April 2011, it had shot up to nearly $50 per ounce. That's more than a 300% gain in roughly 3 years. Gold went up significantly during that same period, but silver absolutely crushed it in percentage terms. And here's the key. That move was driven by many of the same factors we're seeing today. Deficit markets, industrial demand growth, investment demand surging, and concerns about currency debasement. But there's something happening now that wasn't happening back then, and this is crucial. The industrial demand side of the equation is fundamentally different today. In 2008, We weren't in the middle of a global green energy transition. We weren't building out 5G networks across the planet. We weren't seeing the explosive growth in electric vehicle production that we're seeing now. Every single one of these mega trends requires massive amounts of silver. And these aren't temporary fads. These are multi-decade infrastructure build-outs that are just getting started. Solar panels are a perfect example. Each solar panel requires about 20 grams of silver. That might not sound like much, but when you're talking about installing hundreds of millions of solar panels globally over the next decade, those 20-gram increments add up to hundreds of millions of ounces of silver demand. And that silver? It's gone. It's not coming back into the market. It's locked up in solar panels on rooftops and in solar farms where it will stay for 25 to 30 years. Electric vehicles are another massive demand driver. The average electric vehicle uses between 25 and 50 grams of silver depending on the model. Some high-end EVs use even more. And we're not talking about a few thousand EVs being produced. We're talking about millions of EVs rolling off production lines every single year, with that number growing exponentially. The International Energy Agency projects that there will be over 300 million electric vehicles on the road by the end of this decade. Do the math on how much silver that represents, and you start to understand why the supply-demand fundamentals are so compelling. Now, let's talk about mining supply, because this is where things get really problematic for anyone who thinks supply will just magically increase to meet demand. Silver mining is not like turning on a faucet. You can't just decide to produce more silver tomorrow because the price went up today. It takes years to bring a new mine online. You need to find the deposit, which takes years of exploration. Then you need to get permits, which can take years depending on the jurisdiction. Then you need to build the mine infrastructure, which takes more years. And then finally, you can start producing silver. But here's the kicker. Most silver isn't even mined as a primary product. About 70% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. That means silver supply is largely dependent on the economics of those other metals, not on the silver price itself. If copper prices are low, copper mines shut down or reduce production, and silver supply drops as a consequence, regardless of what's happening with silver prices. And we're seeing this play out in real time. Mining companies have been underinvesting in new projects for years because metals prices were depressed for so long. The easy, high-grade deposits have already been mined. New discoveries are deeper, lower grade, and more expensive to extract. The average grade of silver ore has been declining for decades, which means miners have to move more rock to produce the same amount of silver. That's not a trend that reverses itself. So you've got declining ore grades, underinvestment in new projects, long lead times to bring new supply online, and the majority of silver coming as a byproduct of other metals. Layer that on top of surging industrial demand and growing investment demand, and you have a supply-demand situation that's fundamentally broken. The market is in deficit, and there's no quick fix. This brings us back to the question, why 100 ounces? Why is that the number people are talking about? It's not arbitrary. 100 ounces represents a meaningful position that gives you real exposure to this market dynamic without requiring a massive capital outlay. At current prices, 100 ounces is an achievable goal for most middle-class Americans who are serious about protecting their wealth. It's enough to make a difference in your financial situation if silver does what the fundamentals suggest it should do, but it's not so much that it's out of reach. But there's another reason this number matters, and it has to do with market structure. The paper silver market, the futures and derivatives market, is enormous compared to the physical market. There are claims on silver in the paper market that dwarf the actual physical silver available for delivery. This works fine as long as most people are content to trade paper claims and never ask for physical delivery. But what happens when that changes? We've already seen glimpses of this dynamic playing out. There have been periods where premiums on physical silver coins and bars have spiked dramatically above the spot price because demand for physical metal exceeded the immediate supply available from dealers. When everyone wants physical silver at the same time, the paper price becomes almost irrelevant. You can't eat a futures contract. You can't hold a derivative in your hand. Physical metal is what matters when the system is under stress. And this is where holding 100 ounces becomes strategic. You're not trying to trade paper. You're not trying to time the market perfectly. You're holding physical metal that represents real wealth, real industrial utility, and real scarcity. When the paper market and the physical market diverge, which they inevitably do during periods of stress, you want to be holding the physical metal, not the paper promise. Let me paint you a picture of what this could look like. Imagine a scenario where industrial users start getting nervous about supply. They've got production lines that require silver, and they can't afford to shut down because they can't source the metal they need, so they start buying forward, locking in supply at whatever price they need to pay. At the same time, investors are watching the deficit numbers, watching the inventory drawdowns, and they start accumulating physical metal. Dealers start running low on inventory, premiums spike, and suddenly the spot price on the COMEX starts disconnecting from the price you actually have to pay to get physical metal delivered to your door. This isn't theoretical. This has happened before in other commodities. It happened with palladium. It happened with rhodium. When physical markets get tight, prices can move in ways that seem irrational until you understand the supply-demand dynamics. And silver has all the ingredients for exactly this type of move. Now, I want to address something important here, especially for those of you who are thinking about retirement security. The traditional approach to retirement planning assumes that stocks and bonds will provide the returns you need, and that the dollar will maintain its purchasing power. But what if those assumptions are wrong? What if we're entering a period where currency debasement accelerates, where inflation remains persistently higher than the Fed wants to admit, where geopolitical tensions continue to escalate? This is where precious metals, and silver specifically, play a crucial role in a diversified wealth protection strategy. Silver has been money for thousands of years. It's been a store of value across civilizations, across empires, across monetary systems. When paper currencies fail, and they always eventually fail, precious metals endure. That's not doom and gloom. That's just historical fact. And here's something worth considering. If you're sitting on retirement accounts, there are ways to get physical precious metals into your retirement accounts without triggering tax penalties. I'm talking about gold IRAs and silver IRAs, where you can hold physical metal in a tax-advantaged retirement account. If you've got $100,000 or more in retirement savings, this is something you should at least understand as an option. I've put together information on how this works in the description below. It covers the mechanics, the rules, the benefits, and the potential drawbacks. No obligation, just education. But it's worth understanding your options, especially in an environment where traditional retirement assets might not provide the protection you think they will. The geopolitical dimension of this story is something we can't ignore either. We're watching a fundamental restructuring of the global monetary system happening in real time. The BRICS nations are actively working to reduce their dependence on the US dollar. They're settling trade in their own currencies. They're accumulating gold reserves at record pace. They're building alternative payment systems that bypass the dollar-dominated SWIFT network. This isn't conspiracy theory. This is openly stated policy from major economies representing billions of people. What does this mean for silver? It means that as confidence in fiat currencies erodes, as the dollar's role as the global reserve currency is challenged, precious metals become more attractive as stores of value. And silver, being more affordable than gold for most people, becomes the accessible way for ordinary citizens to protect their purchasing power. When people lose faith in paper money, they don't turn to other paper money. They turn to tangible assets with intrinsic value. The Chinese understand this. They've been accumulating gold reserves for years, and their citizens have been buying silver and gold in massive quantities. The Indians understand this. India is one of the largest consumers of precious metals in the world, and that demand is cultural, generational, and deeply rooted. When economic uncertainty rises, Indian families buy gold and silver. It's not a trade. It's wealth preservation that spans generations. And increasingly, Americans are waking up to this reality too. The trust in institutions is eroding. The trust in the dollar's purchasing power is eroding. People are watching their savings get devalued by inflation while being told that inflation is transitory or under control or not as bad as it feels. But you can't gaslight people about their grocery bills. You can't tell someone their rent didn't go up when they're writing a bigger check every month. And when people realize that their dollars are losing purchasing power, they start looking for alternatives. This is where silver shines, literally and figuratively. It's affordable enough that regular people can accumulate meaningful positions. It's tangible, so you can hold it in your hand. It's got thousands of years of history as money, and it's got industrial utility that creates real, sustained demand, regardless of what happens in the investment world. That combination is incredibly powerful. Let's talk about the technical picture for a moment, because this matters for understanding where we are in the cycle. Silver has been consolidating in a range, building a base, absorbing supply. This is classic accumulation behavior. The weak hands have been shaken out. The people who bought at the highs and sold at the lows are gone. What's left is a market that's being quietly accumulated by people who understand the fundamentals and are willing to be patient. When silver breaks out of this consolidation pattern, and it will, the move is likely to be explosive. That's how silver works. It sits quietly for long periods, frustrating everyone who's waiting for it to move, and then it rips higher in a way that catches most people off guard. The people who waited for confirmation, who wanted to see the move before they bought, end up chasing it higher and paying much more than they would have if they'd just accumulated during the quiet period. This is why 100 ounces now, while silver is still relatively quiet, is such a strategic position. You're not trying to catch the exact bottom. You're not trying to time it perfectly. You're building a position during a period when most people aren't paying attention, so that when the move happens, you're already positioned. And based on the fundamentals we've discussed, the deficit markets, the industrial demand, the declining inventories, the underinvestment in mining, the geopolitical shifts, the move is coming. It's not a question of if, it's a question of when. And here's something else to consider: the opportunity cost of being wrong versus being right. If you accumulate 100 ounces of silver and the price goes nowhere, you've got 100 ounces of silver. It's still a tangible asset. It's still got industrial utility. It's still money that's been recognized as such for millennia. You haven't lost anything unless you panic sell at a loss. But if you don't accumulate silver and the fundamentals play out the way they appear to be setting up, you've missed an opportunity to protect and potentially grow your wealth in a way that's very difficult to replicate with traditional assets. The risk-reward here is asymmetric. The downside is limited. Silver has intrinsic value. It's used in thousands of industrial applications. It's not going to zero. But the upside, based on historical precedent and current fundamentals, is substantial. When silver moves, it doesn't move 10 or 20%. It moves in multiples. We've seen it happen before, and the setup now is arguably more compelling than it was during previous bull runs. I want to circle back to something I mentioned earlier about the paper market versus the physical market, because this is absolutely critical to understand. The COMEX silver market trades enormous volumes every day. Billions of dollars worth of silver changes hands in the form of futures contracts. But the vast majority of those contracts are settled in cash, not physical delivery. The system works because most participants don't want physical silver. They want price exposure, and they're happy to settle in cash. But the system is built on the assumption that physical demand will remain a small fraction of the paper trading volume. What happens when that assumption breaks? What happens when a significant percentage of contract holders start demanding physical delivery? What happens when industrial users, worried about supply, start taking delivery instead of rolling contracts forward? What happens when investors, losing faith in paper promises, insist on physical metal? The COMEX has mechanisms to deal with this, of course. They can raise margin requirements. They can change contract specifications. They can, in extreme circumstances, force cash settlement. But all of those actions would be admissions that the physical market can't support the paper market. And that would be a massive red flag to anyone paying attention. It would validate exactly what the silver bulls have been saying for years: that the paper market is a house of cards built on a foundation of physical metal that's far smaller than most people realize. And when that realization spreads, when people understand that there are far more claims on silver than there is silver available to deliver, the scramble for physical metal will be intense. Premiums will explode. Delivery times will extend. And the people who already hold physical silver will be sitting on an asset that's suddenly in desperate demand with limited supply. This is why 100 ounces isn't just a number. It's a strategic position that puts you on the right side of a supply-demand imbalance that's been building for years and is now reaching a critical point. You're not speculating on price movements. You're positioning yourself ahead of a fundamental shift in market dynamics that's already underway. Let me give you one more historical parallel that I think is instructive. In the 1970s, we had a similar setup with gold and silver. We had currency debasement through inflation. We had geopolitical tensions with the Cold War. We had energy crises. We had a loss of confidence in government institutions. And we had precious metals that were dramatically undervalued relative to the monetary expansion that was happening. Gold went from $35 an ounce to over $800 an ounce. Silver went from $1.50 to $50 an ounce. Those weren't small moves. Those were life-changing moves for people who positioned themselves early. Now, I'm not saying we're going to see the exact same percentage moves. Every cycle is different, but the underlying dynamics are remarkably similar. We've got currency debasement through unprecedented monetary expansion. We've got geopolitical tensions that are arguably more complex than the Cold War. We've got energy transitions that are creating massive demand for industrial metals. And we've got precious metals that are undervalued relative to the size of the monetary system. The people who recognized what was happening in the 70s and positioned themselves in gold and silver before the big moves made fortunes. The people who waited for confirmation, who wanted to see the trend established before they bought, paid much higher prices and made much smaller gains. And the people who ignored precious metals entirely and stayed fully invested in traditional assets watched their purchasing power erode despite nominal gains in their portfolios. Which group do you want to be in this time around? That's the question you need to ask yourself. Because the setup is there. The fundamentals are there. The deficit markets are there. The industrial demand is there. The geopolitical tensions are there. The currency debasement is there. All the ingredients are in place. The only question is whether you're going to position yourself before the move or after it. 100 ounces of silver is achievable for most people who are serious about wealth protection. It's not a massive position that requires enormous capital. It's not a speculative bet that could go to zero. It's a strategic allocation to a tangible asset with thousands of years of history as money, with critical industrial applications, and with supply-demand fundamentals that are more compelling than they've been in decades. And here's the beautiful thing about physical silver. Once you own it, it's yours. It's not a promise from a bank. It's not a claim on someone else's balance sheet. It's not dependent on a counterparty fulfilling their obligations. It's metal in your possession that you can hold, that you can store, that you can pass down to your children. In a world of increasing financial complexity and counterparty risk, that simplicity and security is incredibly valuable. So, let me bring this all together. We've got a silver market that's been in deficit for 6 consecutive years. We've got industrial demand that's accelerating due to green energy transitions, electric vehicles, 5G infrastructure, and countless other applications. We've got mining supply that's constrained by declining ore grades, underinvestment, and long lead times. We've got COMEX inventories that represent less than 2 months of global industrial consumption. We've got a paper market that's built on assumptions about physical demand that may not hold. We've got geopolitical shifts that are undermining confidence in fiat currencies. And we've got a historical precedent that shows what happens to silver prices when these dynamics converge. 100 ounces puts you in a position to benefit from all of this. It's not about getting rich quick. It's about protecting your wealth and positioning yourself ahead of a market dynamic that's already in motion. The people who understand this are accumulating quietly. They're not waiting for CNBC to tell them it's time to buy silver. They're not waiting for their financial advisor to recommend it. They're looking at the fundamentals, recognizing the opportunity, and taking action. And if you've made it this far in the video, you're clearly someone who's thinking seriously about this. So let me leave you with this. I've put together a comprehensive guide that goes deeper into wealth protection strategies, including how precious metals fit into a diversified portfolio. It's in the description below, completely free. And if you're an American retiree with at least $100,000 in retirement accounts, you can also schedule a one-on-one educational web conference where we'll walk through your specific situation with no obligation whatsoever. Just mention you watch this video till the end. The opportunity is here. The fundamentals are clear. The question is whether you're going to act on this information or let it pass by. 100 ounces of silver isn't just a number. It's a strategic position in a market that's setting up for a move that could define this decade. The choice is yours.